Most people believe investors spend their time chasing fast money, reacting to headlines, and jumping on whatever trend appears online. That image dominates the public conversation about money. Yet, inside professional investing circles across the United States, the process looks far quieter and far more disciplined. Real investors move slowly. They study opportunities patiently, observe patterns carefully, and filter information long before they place money anywhere. This difference raises an important question. What do professional investors actually look at before deciding an opportunity deserves attention? Understanding that process changes how investing looks from the outside. What appears exciting and unpredictable often begins with a surprisingly simple evaluation method. Professional investors begin with a question that many people skip entirely. What exactly is being offered here? When most people hear about a company, a product, or a new technology, their attention immediately moves toward potential profits. Investors pause before reaching that stage. They examine the structure of the opportunity itself. They want to understand the real business activity behind it. Is the company producing something useful? Is it solving a real problem? Is the demand stable or temporary? These questions may appear basic, yet they quietly determine whether an opportunity deserves further investigation. If the foundation looks weak, experienced investors stop their evaluation immediately. Before any deeper analysis begins, the first filter simply asks whether the business activity itself makes practical sense. Inside American financial markets, thousands of opportunities appear every year. New companies launch products, existing businesses expand, and emerging technologies attract attention from the public. No investor can analyze everything in detail. Because of this, the first skill professionals develop is filtering. They decide what deserves time and what should be ignored. Many experienced investors spend more energy rejecting opportunities than accepting them. If something appears confusing, unclear, or overly complicated, it often disappears from consideration within minutes. This aggressive filtering explains an observation that surprises many newcomers. Professional investors often appear slow while others rush forward. Speed in investing rarely comes from rushing. It comes from eliminating weak opportunities quickly. To understand how this filtering works in real life, consider a simple situation an investor might face during a normal review day. Imagine a professional investor examining two opportunities. The first involves a complex platform, promising rapid growth through multiple digital services. Understanding the business requires several pages of explanation. The second opportunity involves a company producing a simple household product used daily across the country. The entire business model can be explained in a few sentences. Most experienced investors naturally begin examining the second opportunity. This preference reveals an important signal. If an opportunity cannot be explained clearly, predicting its long-term behavior becomes extremely difficult. Clarity often acts as an early warning system for business quality. Another important step involves studying how the business actually generates revenue. Revenue represents money entering a company from customers. Investors move beyond that basic definition. They want to understand who the customers are, why they pay, and whether they will continue paying in the future. Businesses built around real needs usually survive longer. Products solving everyday problems maintain steady demand over time. Opportunities connected mainly to excitement or temporary trends depend heavily on public attention. Attention changes quickly. When investors observe where revenue truly comes from, they begin to see whether a business rests on a stable foundation or on shifting public enthusiasm. Understanding customer behavior often reveals more about a business than promotional messaging ever could. Professional investors also study competition. Although their approach differs from how many people expect, every business operates in a marketplace where other companies pursue the same customers. If a company offers something unique, it gains strength. When many businesses offer identical products, competition becomes intense. Investors look for advantages helping a company remain strong while others struggle. These advantages may include reputation, efficient production, established distribution networks, or trusted relationships with customers. Recognizing these advantages early often separates successful investments from those that quietly fade away. Competitive strength determines how well a business survives pressure from rivals. Numbers matter in investing, yet experienced investors often study people just as carefully. Leadership quality influences how resources are used, how problems are handled, and how the company adapts when conditions change. Investors look for signals of discipline, transparency, and long-term thinking. Businesses guided by steady leadership often navigate challenges more effectively than organizations driven by short-term decisions. This introduces an important realization. Financial analysis frequently involves human judgment as much as numerical data. Strong leadership often strengthens the entire structure of a business. Many market participants focus heavily on immediate outcomes. Professional investors extend their thinking much further. They ask how the business might look several years into the future. Will the product still matter? Will the industry remain stable? Could technological change reshape the environment around the company? This longer time horizon quietly transforms how opportunities appear. Some exciting trends fade quickly when viewed through a multi-year perspective. Looking further into the future often filters out short-lived opportunities. Risk represents another important element. In everyday language, risk suggests danger. In investing, risk refers to uncertainty about future outcomes. Every opportunity contains some level of uncertainty. Investors estimate how large that uncertainty might be and whether the potential reward justifies accepting it. Opportunities with many unknown variables require deeper evaluation because unexpected events may influence results. This measured approach protects investors from reckless decisions and excessive caution. Managing uncertainty remains central to responsible investing, where investors obtain information strongly influences their decisions. Public news, online commentary, and social discussions shape many opinions about markets. Professional investors often go deeper. They read company reports, examine financial statements, and observe how businesses behave over time. Instead of reacting instantly to headlines, they watch patterns developing slowly. Patience reveals signals that rapid reactions usually miss. Reliable information often appears through consistent observation rather than quick reactions. Discipline remains one of the most overlooked traits among investors. New trends appear constantly. Financial media introduces fresh narratives every week. Conversations among friends create additional pressure to participate. Without discipline, investors feel the need to join every opportunity. Experienced investors accept that many opportunities will pass by. Missing opportunities rarely damages long-term results. Entering poor opportunities can create lasting consequences. The ability to decline opportunities often protects capital more effectively than finding new ones. This mindset explains why professional investors spend large amounts of time waiting. Waiting may appear unproductive from the outside. Inside investing, waiting represents preparation. Investors observe markets, study businesses, and refine their understanding of industries. When a strong opportunity eventually appears, they recognize it quickly because the groundwork already exists. Preparation allows decisions to happen calmly when the right moment arrives. Waiting often reflects readiness rather than inactivity. Once an opportunity survives this early filtering process, investors move into deeper evaluation. At this stage, the goal shifts from basic screening to understanding whether the business can remain strong over long periods. Investors begin examining stability, durability, and adaptability. One of the first areas studied involves financial strength. Investors analyze how money flows through the company. They examine revenue patterns across several years to understand whether the business produces consistent results or unpredictable swings. Stable patterns usually indicate that customers continue returning. Sudden spikes followed by sharp declines raise questions about sustainability. These patterns often reveal customer loyalty more accurately than marketing messages. Consistency in revenue frequently signals durable demand. Efficiency receives similar attention. Efficiency describes how effectively a company converts its activities into profit. Investors examine production costs, operational spending, and management decisions influencing the financial structure. Companies maintaining strong efficiency often possess flexibility during difficult periods. Businesses operating with very thin margins face greater pressure when conditions change. Efficiency acts as a cushion when economic environments shift. Scalability represents another important factor. Scalability describes whether a business can grow without losing efficiency. Some companies expand smoothly as demand increases. Their systems, production capacity, and distribution networks adjust effectively. Other businesses experience the opposite outcome. Costs rise quickly, operations become disorganized, and customer experience declines. Investors therefore ask an important question: can this business grow without creating internal strain? Growth only helps when the underlying structure can support it. Every company occupies a specific position inside its industry. Some operate as premium providers known for quality and branding. Others focus on affordability and broad accessibility. Investors evaluate whether the company's position aligns with customer expectations and whether competitors could easily challenge that position. A clear position helps investors anticipate how a business behaves under pressure. Technological change influences many industries across the United States. Investors consider whether a company adapts well as technology evolves. Businesses ignoring technological progress may gradually lose relevance. Companies integrating useful innovations often strengthen efficiency and competitive strength. The real question investors ask is simple: will this company adapt as the industry evolves? Adaptability often determines long-term survival. Customer loyalty provides another signal of business durability. Investors look for evidence that customers repeatedly choose the same company. Loyal customers stabilize revenue, reduce marketing costs, and strengthen resilience during economic challenges. Customer loyalty often forms a protective moat around a business. To see how these factors combine, imagine an investor analyzing a manufacturing company producing household equipment widely used across American homes. Product demand remains steady because households regularly replace these items. The company operates efficient production facilities and distributes products through established retail networks. Customer feedback indicates satisfaction with durability and performance. Competitors exist, yet this company maintains a reputation for reliability developed over many years. When investors observe multiple signals reinforcing each other, confidence gradually increases. Strong opportunities rarely rely on a single positive indicator. Now, consider another situation where a company depends heavily on a single trending product driven primarily by online attention. Demand appears strong during the initial launch period, yet customer behavior shifts quickly as new trends emerge. The company struggles to develop additional products capable of sustaining demand. Investors observing this pattern recognize greater uncertainty surrounding future revenue. Opportunities relying on trends often carry unpredictable outcomes. Experienced investors rarely rely on a single metric. Instead, they combine multiple observations into a broader picture. Financial stability, leadership quality, operational efficiency, market position, customer loyalty, and technological adaptability all contribute to the evaluation. Each factor acts like a piece of a larger puzzle. When several pieces align, the opportunity begins to look far more convincing. Investment confidence usually develops through multiple reinforcing signals. Another major element involves valuation. Valuation describes the relationship between the price of an investment and the underlying strength of the business. Even strong companies can become weak investments if their prices rise far beyond their economic performance. Investors therefore study whether current prices reflect the true condition of the business. If prices disconnect from fundamentals, disciplined investors often choose to wait. A strong business still requires a reasonable price. Markets frequently move through cycles of optimism and pessimism. During optimistic periods, many opportunities appear attractive as prices rise rapidly. During pessimistic periods, fear spreads and prices decline. Investors trained in structured evaluation methods remain focused on fundamentals instead of emotional reactions. Psychology influences financial decisions more than many people realize. Returning to analytical frameworks helps investors resist emotional pressure. Evaluation does not end after a decision. Businesses evolve continuously. Leadership changes, new competitors emerge, technologies advance, and customer behavior shifts. Investors therefore monitor companies over time and adjust their understanding as conditions evolve. Investment evaluation remains an ongoing process. Across the United States financial landscape, the most respected investors share a common habit. They remain curious students of business activity. They read extensively, observe industries carefully, and refine their analytical frameworks through experience. Each opportunity becomes part of a larger learning process. When people begin understanding this evaluation process, financial markets appear very different. Instead of unpredictable gambling environments, markets begin to resemble complex systems where disciplined analysis plays a central role. Opportunities exist within those systems, yet identifying strong ones requires patience, structure, and thoughtful observation. For viewers exploring investing for the first time, the most valuable habit involves slowing down the decision process. Careful questions about business activity, financial strength, leadership quality, and long-term durability create a responsible foundation for investment thinking. Beneath the noise of trends and headlines, real businesses continue producing goods and serving customers across the country. Investors who learn to evaluate those businesses carefully gain a clearer view of where real opportunities may exist. Careful evaluation remains the quiet discipline separating speculation from genuine investing, and anyone willing to study the process can begin developing it.